Well, hi everyone, and welcome to the Buffett and Beyond Weekly ETF video letter. And this is Saturday, March 2nd. Happy March, everybody, 2024. And folks, we are tripling the S&P with top stocks in the tech ETF. We're just beating up on the S&P. Absolutely amazing. We're only 2 months into the year. So, folks, remember, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now, and we're doing that for you, folks. Now, let's look at year to date, and we are, black line is the S&P, or the black lines in here, S&P 500, and up here we have the technology ETF. And the next line down are the QQQs, and you can see both of them for the first 2 months of this year outperforming the S&P 500. What's lagging right now? Well, the semiconductors are, but folks, after today, I don't think we're going to see that line below the S&P 500 right now. I'm recording this midday on Friday, and the market is rocking, setting new records. All right, 1 year. Let's see what happens. 1 year, again, black line's the S&P 500. This line down here, this is the semiconductor ETF. And you can see it's been lagging for a year, well, a whole year here. This is how the chart is. And what is beating and outperforming by a long shot, almost doubling the S&P 500? The QQQs, which is the NASDAQ ETF, the NASDAQ 100 largest stocks, and also the technology ETF, which is this mustard-colored line up here. But let's take a look at how our top stocks are doing, because they make these stocks or these lines up here look minuscule. But first I want to show you one other ETF that has outperformed the S&P 500 this year, and it's the housing industry, the building and the home construction ETFs, which is one of them's not shown here, but together they are both up over 1 year, outperforming the S&P 500. But you could see that over the past 2 months, February in here, this is January in here, you could see they haven't done very much except for the past couple of days in here. So actually, for this year, they haven't done that much as this whole 1 year chart indicates. But let's take a look. So we look at the home builders, and the home builders, well, with the S&P up 7.2%, the home builders are up just 8.8%. But when you look at our top stocks, we are looking at almost doubling the S&P 500. So, folks, it just goes to show that if you can pick the stocks with the fastest growing earnings in any ETF or any index, you will very most probably outperform the ETF or the index itself. And that is the whole theme behind our way of thinking. And we use the clean surplus return on equity, which is right here, and we try to get stocks that are over 20%. Average stock in the S&P has a 13% clean surplus return on equity. So we have a cushion built in there. We use stocks over 20%, and folks, this is what they do. The better than average stocks will outperform the below average stocks every day of the week, and we know how to pick out the better than average stocks, and look at what we're doing right here. Let's go on, folks, and let's go to the technology. Now, the technology is up 9.1% with the S&P up 7.2%, but look at the top stocks in the technology that we picked out for this entire year, up 19.6%, almost tripling the S&P 500. Folks, we are really rocking on these top stocks in our ETFs. Now let's look at the semiconductor ETF. Semiconductor ETF is only up 3.2% for this year, and most of it is coming on Friday. So we're up 3.2% for the year, but look at our top stocks, up 24%. That's tripling the S&P 500. And 8 times more than the index itself. So if you know how to pick the right stocks in any index or ETF, folks, you got it. You got it made. And of course, we could thank a lot of this to NVIDIA, up 65% this year alone. AMD up 36%. So the top stock, if you know how to pick the top stocks in an ETF, folks, you are going to make some serious money. Don't forget, the semiconductor ETF is up only 3.2% this year, but our top stocks are up 24% for this year. Now, we want to show you something with the NASDAQ 100. We were talking about hedges, and we can hedge with the SQQQ, which means short the QQQs. And when we hedge with the SQQQs, we can put 97% of our money into our top stocks, 97%, and use 3% to hedge about 10% because it's a 3-for-1 inverse ETF. Now, we like to look around 30%. So if we want to hedge 30%, it only takes 10% of our money. So let's look at the NASDAQ. The NASDAQ is up 8.2% with the S&P up 7.2%. But our top stocks are up just about 17%. Folks, with the QQQs up 8% and our stocks up 17%, we're doubling the QQQs and more than doubling, 2.5 times the S&P 500. So if we hedge with 10% of our portfolio or 30% of our portfolio, let's look at 30%. Now again, to hedge 30% of our portfolio, it only takes 10% of our money because this is a triple ETF. It's a triple inverse ETF. So we come down here and we say, all right, if we put 10% of our money into this ETF, we can hedge 30% of the ETF. So that means that we have 90% to put into these top stocks. So instead of getting 16.9%, we would gain 15.2%. But this hedge went down in value because the QQQs went up in value, and we would have lost about $3,000. So all in all, we would have made 12.7% by being 30% hedged. Now, the key is that we are still way outperforming the S&P 500. We are reducing our risk, and when the market goes down, we will have, let's say this 8.2% goes down 24%, because the market likes to go down about 20% every now and then. And what do the QQQs do? They go down more than the S&P 500. So let's say we go down 24%. Well, if we go down 24%, our money, our hedges are going to make about $8,000 or $9,000. What do we do with that money? We buy more stocks with it because our insurance policy is paying off. We buy more stocks with it. Maybe not different stocks, maybe the same stocks, because they're at lower prices. That's how you add to the portfolio without going in on margin and without taking money out of your pocket. Let's put some dollars on that. So here we go. We want to hedge 30%. We would lose on, now this is today, we would lose about 3 or 4 percentage points, which is about 24% of this money right here. And it comes to down here because we're losing about 24%. Where do I get that? 3 times the 8.2%. So the QQQs went up 8.2%, but since we're short, or we're buying, I should say, the triple inverse ETF, we would lose 24%. But that's 24% of $10,000, and that would be the $2,400 down here. So we are still ahead. Instead of being ahead $116,000, we're ahead $12,700. What if the market had gone the other way? What if the market had gone down to 24%, just like in the last slide, or 20%? This would be about $9,000, close to $10,000 that we would gain on our hedge. So with a $100,000 portfolio, if the market goes down 20%, we would gain almost $10,000 on our hedge, and we would use that $10,000 to buy more stocks. Now, don't forget, we started with $100,000. So if the market goes down, we now have another 10% or so to buy more stocks without taking money out of our pocket and without going on margin. Folks, that's the way hedging works. So we can see that with all our top stocks and the top ETFs that we use, the technology, the semiconductors, the QQQs, and our triple superstars or ETF top stocks, we have another portfolio made up of the QQQs, made up of the semiconductors, made up of the technology stocks. Put them all together, and we have a portfolio that's doing about the same here, doubling and almost tripling the S&P 500 right now. So, folks, we'd like to put some hedges in there. We keep them all the time, so we don't have to worry about trading them. And we could sleep better at night. And we know that someday when the market falls, we can cash in our hedges and buy more stocks. That's how you add to the portfolio. And over the years, that's how you become wealthy. So, folks, those of you who like this ETF and want to learn more about hedging, you could get a 2-week free subscription. We just need your name and email. Go to www.buffettandbeyond.com and sign up for your 2-week free subscription. So, okay, folks, we had a really good week this week. We ended the week with the NASDAQ at new all-time highs. And, folks, if you want to be on this beach at sunrise and walk the beach like Jimmy Buffett once did, then you've got to learn how to invest even better than Warren Buffett does now. And, folks, that's what we teach you with our subscription and our newsletter. All right, folks, you stay safe. You have a great weekend, and we'll be back here next week with more stocks and more results. Have a great weekend.